Hey everyone, and welcome back to the channel. We need to talk about something urgent and frankly pretty frustrating that's hitting millions of Americans right now. If you have student loans, especially federal ones, listen up because your balance just started growing again as of August 1st. For nearly 8 million borrowers, a crucial lifeline, the SAVE plan, which offered unbelievably low or even $0 monthly payments and prevented your loan balance from ballooning due to interest, has been dramatically altered. This isn't just a minor tweak. For many, it feels like the rug has been pulled on from under them. People are feeling crushed. The SAVE plan was launched back in 2023 under the previous administration, designed to make repayment affordable by basing your monthly bill on your income and family size, and preventing interest from piling up. It was supposed to be a game changer, giving people like Andrea, a doctor of pharmacy with over $200,000 in debt, a way to finally see their balances go down instead of up. She even switched to SAVE because it slashed her monthly payments to about $400. For people like Jessica Ochoa, it made life affordable enough to buy a house and have a child. But SAVE faced legal challenges almost immediately. Courts blocked key parts of the program, leading to millions of borrowers being placed in a special forbearance period where payments and interest were both paused. Well, that interest pause is over. Now, the current administration has said it's resuming interest accrual, claiming it's necessary for fiscal responsibility and to comply with court orders. But critics argue no court actually demanded this interest restart, meaning it was a choice that could cost borrowers billions. In fact, the Student Borrower Protection Center estimates the average SAVE borrower will see their debt grow by about $300 a month in new interest charges, adding up to over $3,500 extra per year. That's a significant hit, especially for low-income families. So what can you do if you're on the SAVE plan and feeling completely lost? First, doing nothing is an option, but it comes with a big catch. Your credit score won't be hurt because payments are still technically paused. However, your loan balance will keep climbing thanks to that accruing interest. This can make it much harder to pay off your debt in the long run. Think about Bronte, a medical resident with almost $300,000 in loans whose SAVE application wasn't processed, and now interest is accruing, making her feel like the financial walls are crushing down. Your second option is to switch to a different repayment plan. The Education Department is actually urging borrowers to do this. The most recommended option right now is the Income-Based Repayment Plan, or IBR. Like SAVE, IBR caps your monthly payments based on your income. But here's the kicker. Your payments on IBR will likely be much higher than they were on SAVE, potentially even double for some. Forgiveness under IBR is also currently paused while the Education Department updates its systems. If you want to switch, you can apply on the federal student aid website, studentaid.gov. Be prepared for delays, though. The Department of Education has a backlog of over 1.5 million applications for income-driven plans. A third option, if you can afford it, is to make voluntary interest payments. This won't count towards loan forgiveness, but it will help prevent your balance from growing even larger while you're in this limbo. There's also a new plan coming, called the Repayment Assistance Plan, or RAP. This plan was enacted under the current administration's One Big Beautiful Bill. RAP is expected to launch by July 2026. It will offer some interest and principal subsidies, meaning it could waive excess interest above your payment and apply a small portion of your payment directly to your loan principal, unlike older plans. But RAP has significant downsides. Payments will likely be higher than SAVE, and it requires a 30-year repayment term before forgiveness, which is much longer than SAVE's 20 or 25-year terms. It also has a less generous way of counting family size for payment calculations and isn't adjusted for inflation, meaning your payments could effectively increase over time. For those pursuing public service loan forgiveness, or PSLF, this situation is also tricky. While PSLF itself isn't seeing major changes, the time your loans spend in forbearance won't count towards the 120 payments needed for forgiveness. There is a buyback option to make these months count, but you'd still pay the equivalent of what your monthly payment would have been. The confusion and financial strain are already causing wider problems. Nearly 74% of borrowers surveyed say student loan debt has delayed major life events, like buying a home, having children, or getting married. In critical sectors like medicine, the high cost of education is contributing to a projected shortfall of tens of thousands of primary care physicians. It's easy to feel paralyzed by this debt. People like Sarah Letzinger and her husband, with over $100,000 in student debt, are postponing plans for more children and struggling to afford travel or even hobbies. My advice is don't ignore this. Contact your loan servicer. Use the Federal Student Aid Loan Simulator tool to understand your options and estimate potential payments. Understand that solutions exist even if they're not perfect. Update your contact information with your loan servicer and federal student aid so you get real-time updates. This situation is complicated, but being proactive is your best defense. The bottom line is, while payments are still paused for now, your loan balance is almost certainly growing, and waiting will only make it worse. It's time to make a plan. If this information was helpful, please hit that like button, subscribe to the channel for more straightforward financial insights, and ring that notification bell so you never get caught off guard by the next change. We're here to help you navigate these challenging financial waters. See you next time.